Hey guys, what's up? I'm Erin and welcome back to the channel. Let me ask you something. What if there was a retirement strategy that allowed you to spend more when the markets are up, nudged you back a little bit when they're not, all while enhancing your long-term success? That's the idea behind the Guyton-Klinger withdrawal strategy, a flexible, rules-based approach designed to keep your retirement sustainable even when markets are unpredictable. In this video, I'm going to show you exactly how it works, why it can outperform traditional strategies, and how to apply it to your plan step by step with numbers. You've probably heard of the 4% rule, recently updated to 4.7%. The idea that you can withdraw 4% of your portfolio in your first year of retirement, and then in each subsequent year, adjust that number by inflation. It's simple, it's straightforward, but sometimes retirement isn't that simple. Markets fluctuate, inflation changes, your lifestyle evolves, but the 4% rule doesn't respond. It stays the same year after year. Whether your portfolio is 20% up or 20% down, it doesn't really respond to that. There's no flexibility built in. And this could put your long-term plan at risk or leave you underspending for decades and missing out on the life you worked so hard to afford. The Guyton-Klinger strategy solves for this by introducing guardrails, allowing you to increase your spending a bit when it's safe to do so and nudging you back when you need to. I like to think of it as lane assist for a car. You're in control still, but you have a system in place that prevents you from veering off track. At its core, the Guyton-Klinger strategy is a dynamic withdrawal system. It adjusts based on what is happening with your portfolio, not static assumptions. And it's built around three key components. Your initial withdrawal, which is often 4%, but you can customize it to your portfolio and your risk tolerance. Spending increases when your portfolio does well, and spending cuts when your portfolio dips below critical levels. These are the guardrails, and they're here to keep your strategy flexible while also being protective. Here's how they work in practice. Let's say you retire with $1 million portfolio and withdraw 4% in year one, and you set your guardrails at plus or minus 20% of that withdrawal. That gives you an upper guardrail of $48,000 and a lower guardrail of $32,000. Each year you ask, is my withdrawal within this range? If it is, great, no changes needed. If it goes above that upper guardrail, well, then maybe you give yourself a raise because your portfolio has grown and it's done well. If it dips below that lower guardrail because the market performed poorly and your portfolio is down, well, then you do a modest cut to protect future income for yourself. And here's where things get really personal. That plus or minus 20% range, that's just the general recommendation. Many retirees use tighter guardrails to keep their spending within a smaller range, or wider guardrails for more flexibility. It really depends on your tolerance for market volatility and how much of your spending is truly essential. What you don't want to be doing is reacting to headlines or daily swings. You want to be following a system that is based on data, but also gives you real-life flexibility. Now let's talk about the million-dollar question. Can the Guyton-Klinger strategy actually help you spend more in retirement? Dynamic strategies like this, with guardrails and adjustment rules, have been shown to support higher withdrawal rates over time. In fact, a study by Vanguard found that using a dynamic withdrawal system could allow retirees to spend up to 30% more over the course of retirement compared to static approaches. And even Guyton and Klinger's original research found that retirees who use their full set of rules, which we'll cover in a minute, including inflation pause, capital preservation cut, and prosperity raise, could often start with withdrawal rates as high as 5.8 to 6.2%, depending on market conditions. And why does it work? Because it's not guesswork. You're not locking yourself into a number that's too low or one that's too high and too risky. You're adjusting with purpose, spending more when the markets are strong and pulling back a little bit when necessary. That's what makes this strategy so powerful. It helps your money last, but it also gives you permission to spend it. It gives you peace of mind without leaving money on the table. Let's walk through a real-life example so you can see exactly how the Guyton-Klinger guardrails work in practice. Say you retire with $1 million portfolio and choose a 4% initial withdrawal rate. That gives you an initial income of $40,000 per year. We're going to introduce plus or minus 20% guardrails from that amount. So the upper guardrail is $48,000, the lower guardrail is $32,000. These aren't arbitrary. These are guardrails that you choose that are working for you and your portfolio. And each year, rather than reacting emotionally to how the market performed, you simply ask, is my withdrawal within my guardrails? Now, let's say the market does well. Your portfolio grows to 1.25 million. Your withdrawal has crept up to 50,000, which is now above your $48,000 upper guardrail. What happens? The strategy resets your withdrawal down to the upper guardrail of $48,000. This is still a raise from where you started, but a disciplined one. It's not simply chasing market highs, and it's not inflating your lifestyle too much. The guardrails aren't just about downside protection, they're also protecting your future self from overspending when times are good. Yes, you can increase your income, but you want to do it in a way that is safe and sustainable and protects long-term income. Now imagine the opposite. Markets drop, your portfolio falls to $750,000, and your current withdrawal slips to $30,000, below your lower guardrail. What happens? The strategy increases your withdrawal back to the lower guardrail, $32,000. This is really the key. That lower guardrail isn't a trap door you can fall through, it's a support beam. Rather than slashing your spending further, you stabilize at a safer level. It's a modest correction, and you stay here until things improve. This works because you're removing the guesswork. You're not giving yourself an unlimited raise anytime the market increases, and you're not completely slashing your spending or panicking every time the market falls. You're following a system, one that gives you permission to spend when markets are strong and a plan to adjust when they're not. It's intentional and predictable and keeps your retirement income or spending responsive to real life without overreacting. The strategy uses 3 core adjustment rules, each designed to guide your spending without forcing drastic changes. Number 1, the inflation rule. This is one of the most subtle but powerful rules with this strategy. It kicks in when the prior year's market performance was negative, but your withdrawal is still within the guardrails. What happens? You pause your inflation raise for the year. You're not taking a pay cut, you're just skipping the cost of living adjustment. That pause gives your portfolio space to recover from a tough year without having a full-blown reaction. And here's where the strategy gets really smart. Most years, the market is doing just fine. Your withdrawal will tend to increase with inflation, and the guardrails will increase with it. So while you might start retirement with a $40,000 withdrawal and guardrails at $32,000 to $48,000, 15 years later, your withdrawal might be $57,000 with updated guardrails around $45,000 to $68,000, staying at that plus or minus 20% range. This is how this strategy evolves with you. Your income grows and so do your benchmarks. It stays in sync with the real world, not frozen in year 1. It's disciplined and dynamic. Number 2, the capital preservation rule. This rule kicks in when your withdrawal has drifted below your lower guardrail, which usually might happen after sustained poor performance. So what happens? You cut your withdrawal just enough to bring it back up to the lower guardrail. This is a real reduction, but it is targeted and not panicked, and it's designed to really allow your portfolio to stand the test of time. And number 3, the prosperity rule. This one rewards strong markets and steady hands. Let's say your withdrawal has drifted above your upper guardrail because your portfolio has grown because of good performance or inflation adjustments. Here's what happens. You get a raise, but it's a controlled one, resetting back down to the upper guardrail. It's permission to enjoy the upside without letting your spending spiral. The bottom line, the inflation rule is a temporary pause. The capital preservation rule is a protective cut, and the prosperity rule is a disciplined raise. Each rule, simple on their own, work together to create a system that is flexible and responsive without overreacting. You are not at the mercy of the market. You are staying in control, one guardrail at a time. Let's walk through a 5-year example that shows how this rules-based system keeps your plan on track, especially when the markets get bumpy. Remember, we don't want to react emotionally. We essentially just want to follow a clear-cut decision tree. We'll establish our baseline. The initial withdrawal will have a $1 million portfolio set with a 4% withdrawal. That's $40,000. Use plus or minus 20% guardrails. So our lower guardrail, $32,000. Our upper guardrail, $48,000. So in year one, we'll assume we take our $40,000 withdrawal at the beginning of the year. We'll assume the market returns 6%, giving our portfolio an ending balance at the end of the year of over $1 million. This is just our baseline in year one. There's no rules that get triggered. We just take our first withdrawal. It's smooth and simple. Now going into year two, we look at how the market performed last year. Last year it was positive. The inflation rule applies. Let's say inflation was 3%. Our withdrawal would be $41,200. We ask ourselves, is it within the guardrails? The answer is yes. So our retiree simply decides to take their inflation-adjusted withdrawal. Now the remainder of the portfolio has stayed invested. Market returns 8%. Ending portfolio balance, again, over $1 million. Now you might be thinking, wait, if the market did so well, why is our retiree not spending even more? And here's where we'll talk about that prosperity rule again. You don't automatically have to increase your spending to the upper guardrail. You have permission to do so if you want to. But if you're fine with just the inflation-adjusted raise, then go ahead and take that. You have flexibility as long as your withdrawals are within these guardrails. Now, as we go into year three, we look at how the portfolio performed in the past year, which was a positive 8%. We are again eligible for another inflation raise. In this situation, we'll assume inflation was 3%, giving our retiree a withdrawal of $42,436. Again, our retiree can just take the inflation adjustment, or they can adjust up to that upper guardrail if they so choose, but they are not required to do so. If they want to leave more of their money invested in compounding for the future, they can absolutely do that. In year three, we're going to assume the market performs poorly, giving us a negative 12%. So now our portfolio ends just under $900,000. In our situation, our retiree is taking their withdrawal at the beginning of the year, so they're not reacting to how the market performed this year until we end up in the following year. So as we go into year four, we evaluate based on the previous year's performance, that negative 12%. The market was down, so the inflation rule now says no raise. So we hold that withdrawal flat at $42,000. Now we're going to assume that the market has another bad year. Negative 7%, and our ending portfolio balance is about $789,000. Let's check on that withdrawal rate. So we take the withdrawal we took this year, dividing by the ending portfolio balance. We now have a withdrawal that is 5.38%. This is above our upper guardrail. As we go into year five, the capital preservation rule gets triggered because our withdrawal of 4% on this portfolio would put us below that lower guardrail. So we adjust up to the lower guardrail and keep our withdrawal at $32,000. And in year five, the market begins to rebound, giving us a return of 9%. Now our portfolio grows to nearly $826,000. So since our portfolio is recovering, next year we would likely be able to increase our spending. If our portfolio increased enough, it might even trigger the prosperity rule where we hit the upper guardrail. It all depends on how the market performs in the previous year. So over this 5 years, we saw a pretty volatile market, but our retiree had a plan. They were able to increase their spending when the market was up. They can increase by just the amount of inflation if they want, or they can increase all the way up to that upper guardrail. It depends on their personal needs within those years. And when we fell below that lower guardrail, we increased our spending just to that baseline guardrail and waited for the market to improve. The biggest win here is that our retiree got to stay calm and followed a plan. They knew no matter what the market did, they had a course of action to follow. This is what dynamic retirement spending looks like. It's not about guessing, it's about trusting the rules and giving your plan the flexibility to adapt over time. And a quick note before we continue, that previous example was a bit overly simplified, and that's simply because we're in a YouTube format here. If you were to take a withdrawal from your portfolio, it's unlikely that you would do one massive withdrawal right at the start of the year. Instead, you might take something quarterly, or you might take it monthly, you might even take it bi-weekly. It all depends how you want to take your withdrawals in retirement. Now let's talk about the trade-offs. Because like any strategy, the dynamic guardrails comes with both pros and cons. The pros are that they adapt to the market. You're not blindly spending. They prevent knee-jerk overcorrections. They allow for upside flexibility. When the market is strong, you can spend more. And more importantly, it gives you the confidence to spend even in uncertain times. The cons are they do require annual check-ins and a bit of discipline. Your income may go down temporarily, and that can be tough emotionally. And yes, they're a little bit more complex than a simple 4% rule. But in return, you get a more realistic, more responsive retirement plan, one that bends without breaking. Who benefits most from this kind of system? DIY retirees, those who have flexible discretionary spending, those who are really nervous about following a strict 4% rule only allowing for inflation adjustments and concerned that their portfolio may run out of money, and even those who have a bucket or a blended income strategy. If you want structure without feeling boxed in, this can be a really great fit. And really, the biggest benefit of this plan is emotional reassurance. You're not constantly asking yourself, am I spending too much, or reading the headlines and reacting emotionally. Instead, you're following a system, given data points, and staying on track. It's about being steady and flexible and having enough to spend today while also knowing that you will have enough to spend in the future. You don't have to guess, you don't have to panic, you simply adjust when life or the market says it's time. So if you're looking for a strategy that adapts with you, a dynamic withdrawal strategy might be worth exploring. Let me know your thoughts in the comments down below. I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing. Or if you know of someone who might get something out of this type of content, please consider sharing. I'll see you soon. Bye. Move it over just a little bit. I think we're good. Additional strategies and how you can apply it. Well, maybe you give yourself a little bit of raise. A little bit of raise. No. I already said overtime, and I want to say overtime in the next sentence. I'm not doing that. Too much repetition. Adjustments over time have been, don't say overtime, and adjustments, returns in the market were negative. I don't. Disciplined and dynamic. There was a pause. I didn't like it. Just following a decision tree. Decision.